All right, so let's get started. Units of production is the next method that we're going to do. Units of production, unlike straight line, in the denominator, instead of using time, useful life is time, what we're going to use is total units of production. So what we're saying different in units of production, that's different than straight line. Straight line is saying, hey, over time an asset deteriorates. What units of production is saying is that over usage, an asset deteriorates, right? So it's the same numerator, cost minus sales value, but its total units of production is in the denominator. And how we find our depreciation expense, we take the depreciation per unit, that's what we're calculating here, and then we'll multiply it by how many units we created during the period. So think of a piece of machinery that creates, let's say, widgets. Do you guys know why every economist and accountant and business person always uses widgets? Like that's their go-to business. You'll hear it like 50,000 times. Because Adam Smith used widgets in multiplication. So it's like an homage. All right, go on. Right? So, and I will not cut that out of the video.
I'll be looking for it.
Okay. All right, on December 31st, 2012, the equipment was purchased for $50,000 cash. The equipment is expected to produce 100,000 units during its useful life and has an expected salvage value of $5,000. 22,000 units were produced in 2013. What is the amount of depreciation expense? So first off, we're going to find out what's the depreciation per unit. So we're going to take the 50,000 minus $5,000. It's the cost minus the salvage value. You get $45,000. Divide that by, they estimate that the machine can make 100,000 units. So we're going to get depreciation be 45 cents per unit. So in the first year, if they created 22,000 units, you just multiply that by the 45 cents per unit and you get $9,900. That will be your depreciation expense for 2013. So let's look at the depreciation schedule. In 2014, they created 28,000 units. So we take the 45 cents times 28,000 units, you get $12,600. So $40,100 minus $12,600 is $27,500. As I say to you last class, make sure you do an Excel spreadsheet for this. I would suggest you go through the minutia of doing every number. That makes sense? And let the Excel spreadsheet kick this out for you. In 2015, they didn't operate the machine, so there's no depreciation expense. 2016, they created 32,000 units, 45 cents each is $14,400. 27,500 minus $14,400 is $13,100. In 2017, they made 18,000 units. You times that by 45 cents a unit, you get $8,100. 13,100 minus $8,100. This gives you 5,000, which is the salvage value. Questions? Last but not least is double declining. Depreciation. Double declining depreciation is an accelerated depreciation method. Right? Sometimes stuff does not, sometimes what you see over time is an accelerated depreciation. So think about your cell phone, right? If you were to do a chart of usage over time, your cell phone will probably start off with a lot of usage within the first year and then just fall off. And by the third year, it will be almost to no usage at all. You with me? So most of your usage is in the front is front loaded, so therefore you wanna take out your depreciation early. If that would best represent what's going on in your company. So that's why you would use something accelerated like double declining. So double declining, we'll take the straight line rate. So you take 100% divided by useful life. As I stated before, to you scholars, useful life is given to us, so it's 5 years. So we take 100% divided by 5 years, we get 20%. It's called double declining. So I said, me created this. So what are we gonna do? We're gonna double it. 20% times 2, right? Give you 40%. Then we'll take the 40% and multiply that by the book value to get the amount we will depreciate at that period of time.
You gonna cut this out?
This is organic. I'll let that stand.
Is it recording right now?
Yeah.
No, it takes a while because I'm a talker, or I can be a talker. Alright. So if you take 40% of $50,000, you get $20,000. Let's look at the depreciation schedule. I think there's a better representation here. So we took 40% of $50,000, we get $20,000. 50,000 minus 20,000 is 30,000. That's year one. The second year, we're gonna take 40% of $30,000. So 40% times 30,000 is $12,000. 30,000 minus 12,000 is 18,000. Let me take a second here to show you how front-loaded this is. We've taken $32,000 of the $50,000 valuation in the first 2 years. It's quite a bit. That makes sense. It's what? 64% of the value we depreciate in the first 2 years, as compared to the others where we didn't get, I don't think we got past 40% the first 2 years. There's a lot of depreciation to be taken off in the first year. But as I said, this is accelerated. Normally this reflects stuff like electronics. Right? So 18,000 times 40% is 7,200. 18,000 minus 7,200 is $10,800. 40% of $10,800 is $4,320. 10,800 minus $4,320 is $6,480. And in 2017, our last year, 40% of $6,480 is $2,592. $6,480 minus $2,592 is $3,888. Is that correct? No. Why is it not? Why is it $3,888 correct? What are your 3 terms that I gave you in the beginning of depreciation? There's 3 things that you have. What are they? first
Tangible in nature?
one? No. Cost. So let's start, let me just, cost. $50,000 is your cost, right? Salvage value
And useful life.
and useful life. Useful life is 5 years. 1, 2, 3, 4, 5. Here's your 5 years. And useful and salvage value is what? Where's your salvage value? No, where is it on here?
3,888.
3,888. Is this your salvage value? No. What is the salvage value supposed to be? Supposed to be 5,000. So the question is, do you keep this at $3,888, or do you change it back to 5,000? The answer is you change it to 5,000. Right? So this is below the salvage value. Remember, every time you're doing this, you do not go, when you're doing depreciation, you do not go past the salvage value unless you make an adjustment to the numbers. So in the last year, we're not gonna take 40%, we're just gonna take the difference between $6,480 and 5,000, which is $1,480 to get the 5,000. Are you with me, scholars?
How do we know what the salvage value is on this contract?
No, it'll be given to you in the question.
Okay.
Yeah. In the questions, for this class and the questions that we give it to you. In the real world, you will estimate them. You will do an estimation. This is just a paragraph showing you, the straight line, the units of production, and useful life. Just like I showed you in this line graph, that bar graph is showing you that you use that product a lot, it depreciates a lot in the beginning of years, and it curves off at the end of the year. Now, looking at all of these, which of these do you think the taxing agencies, the IRS, prefers one to use? Which one would they prefer you to use?
The IRS.
Mm-hmm. The first one, they prefer you to use this, straight line. It's simple. You know, oh, well, they're gonna take $5,000 a year. They just look for $5,000 a year. Plus, it's not heavy in the beginning. Now, which one will corporations use? Which one will corporations use? I'll give you a hint. You don't even have to look at that to give me an answer. Which one will they use?
The bottom one.
Mm-mm.
The most person?
The one that's most profitable. Thank you. Thank you. I told you I'd give you a hint. I could take all the questions down. You still should be able to answer the question. The one that's most profitable. Remember, they are still a profit motivated entity. So they're gonna do the one that's most profitable. Most corporations though use makers. We call it makers. It's modified accelerated cost recovery system, right? For tax purposes, makers. Depreciation provides for rapid write-off. One of the last topics we'll talk about is partial year. This is if you get an asset, and most people do, they get their asset in between the year. So let's say, for instance, equipment was purchased June 30th. The equipment costs $75,000 and has a useful life of 10 years, and a salvage value of $5,000. Right? The first year, you you only had the equipment for 6 months, because you got it June 30th, so think July, August, September, October, November, December, 6 months. So you would take whatever the depreciation would be, so this is the cost minus the salvage value, divided by the useful life, will give you $7,000 a year. Take the $7,000, what it would have been for the year, multiply it by how many months you have it in that year, divided by 12 months in a year, and that will give you $3,500. Does everybody understand the concept? Okay. Changing estimates of depreciation. Sometimes you will change your estimate in the middle of depreciating an asset. For an example, on January 1st, 2013, equipment was purchased with a cost of $30,000. It had a useful life of 10 years and no salvage value. 3 years later, and we're in 2016, at the start of 2016, the useful life was revised to 8 years total, 5 years remaining. So it started off with a useful life of 10 years, now they say, no, we think it's only 8. What do we do? So we're gonna calculate depreciation at year end using straight line. So what we're gonna do, we're gonna take the book value at the date of change, minus the salvage value at the date of change, and divided by the remaining useful life. So the asset costs $30,000. We depreciated straight line over 3 years. So it's $3,000 a year, multiply that by 3 years, you get $9,000. So right now the book value had $21,000, remaining, I'm sorry. We divided by the remaining useful life, which is 5 years. Remember, they went from 10 years to 5 years. So from here on in, they only have 5 more years remaining, if you went off. And so $21,000 divided by 5 will give you $4,200.
Years are old.
That would be your depreciate, your debit the expense, credit the accumulated depreciation. It's just reporting depreciation. When we reported, the accumulated depreciation will be on the balance sheet, is a contra asset. I think I've discussed that in the last video. Is property, plant, equipment, gross minus the accumulated depreciation gives you the net. And that's what it would look like. I'm worried about the disposal of an asset. Yeah, let's talk about disposal. Disposal of an asset is when you sell or you get rid of the asset at the end of its useful life or sometime afterwards. If the cash you receive is more than the book value, then you have a gain, you have a one-time gain. So you need to record a credit. If the cash you receive is less than the book value, then you need to record a loss or a debit. If they're equal, then you just broke even. So no gain or loss. So in our example, on September 30th, 2013, Evans Company sells a machine that originally cost $100,000 for $60,000. The machine was placed in service on January 1st, 2010. It was depreciated using straight line method with an estimated salvage value of $20,000 and a useful life of 10 years. Annual depreciation, $100,000 minus the $20,000 divided by the 10 years is $8,000 a year. Depreciation as of September 30, 2013, when they sold. September is the 9th month, so 9 divided by 12 times, which would basically be 75%, times $8,000 is $6,000. So you would take out the $6,000 for that year. And so it costs $100,000. 3 years times the $8,000 would be $24,000. Plus the $6,000 give you $30,000. So it has a book value of $70,000. They received $60,000 cash for the asset. The 60,000 is less than their book value. So they can report a loss on their books of $10,000 for disposing of the asset. Does everyone understand how that works? Current book value minus whatever you received in cash. And there's your journal transaction. Debit cash, debit accumulate depreciation, debit the loss, credit the machine. All right. Last but not least, I'm going to talk to you, I know I'm flipping. I'm going to talk to you about, the last piece I'm going to talk to you here is about more about language. Okay. When we're saying depreciation, we're giving our audience a understanding of what type of asset we have. When we say depreciation, we're giving our audience an idea of what type of asset we have. We're talking about a machine, piece of machinery. We're talking about a building or anything that's tangible. Everybody with me so far? We depreciate those types of things. Now, when we talk about depletion, which is up on the board here, we're telling our audience that we have a natural resource. This is the point. This is the place in business where individuals want to get. They want to make themselves out to be smarter than they are. So sometimes they'll start rolling words out, and they'll be like, "Oh yeah, let's amortize that," not realizing that these words have a specific meaning and a specific background and the place in which they're supposed to be used, right? So depletion, we do depletion when we're talking about a natural resource, a diamond mine, or oil drilling, or coal mines. That's when we're talking about natural resources. That's when we talk about depletion. Now, how we do depletion is the same way we do units of production, right? Remember I said depreciation per unit? Now it's depletion per unit. It's the same concept. Cost minus the salvage value divided by how many, in this case, when you're talking about a natural resource, how much production they believe they can get out of that resource. So here, if it's a mine, they think they can get 40,000 tons from it. So they're going to deplete this asset by $25 per ton. So every time they take out a ton of ore, they're going to recognize $25 of depletion. Everybody with me? Are you with me or you're not with me?
Yes.
Okay, good. Next is amortization. Amortization, just like depreciation is for tangible assets, we amortize intangible assets. Leaseholds, copyrights, patents, these types of things, goodwill, trademarks. Most of the time we'll do this by straight line. But when I say amortization, I'm talking about an intangible asset. When I say depletion, I'm talking about a natural resource. And when I say depreciation, I'm talking about a tangible asset. Is everyone with me? That's a major thing. How we do it is very similar to the three forms I showed you: straight line, units of production, and double declining. But all these words have meanings, so just don't throw it out. I see people all the time like, "Oh, let's amortize that building." It's improper use of the word. What I tell you in business, you show yourself to be right you show yourself not to be, knowledgeable of the topic you're talking about, what will business people do? Are they gonna debate you? No, what are they gonna do? You're gonna ignore it, just stop talking to them.
Wait, so both depreciation and depletion are tangible assets?